In accordance with India's 109, the business model assessment is one of the two criteria to decide classification of debt instruments. Here, business model refers how entity manage its financial assets to generate or realize cash flow. It may be by holding the assets till maturity or by selling, or there may be another way by holding and selling. So ultimate, we need to find out how it manages the assets to realize the cash flow. And here, assessment is not to perform on worst case or stress case scenario basis, but we need to check the regular activities to generate the cash flow. And it is decided based on reasonably expectancy of occurrence of the transactions related to financial assets. Entity may have one of two models for debt instruments. One is hold to collect contractual cash flow where the assets are held till maturity. Another may be by holding and selling the financial assets. Here, business model objective is achieved by both holding and selling the financial asset, and decision is taken ongoing basis which action maximize the returns on the debt instrument, whether the holding of debt instrument will maximize the return or selling the financial asset will maximize the return. So based on that, decision is taken. This model is called hold to collect and sell financial assets. Other third model may be where we need to realize cash flow through sale, and decision to hold and sell financial assets is based on the assets fair value, and it results in actively buying and selling the financial assets. Financial assets, those are categorized in this model, are measured at FVTPL. Business model determination is matter of fact, not of the assertions, and the activities should be observable to achieve its business objective of the model, and entity need to use judgment to determine the business model of managing financial assets, and determination is not based on the single fact, but the determination is based on or relevant factors available on the assessment date when we are going to decide the business model. For example, how the performance of business model and financial assets is evaluated and reported to the management, and risk that affects the performance of business management and how we mitigate these risks. Those are affecting the business model. Next is how the managers of business are compensated, whether compensation is based on the fair value of assets managed or it is based on the contractual cash flows those have been generated. Next is what label business model assessment to be applied, whether it is to be applied on by instrument basis or it has to be applied on aggregative basis. So the label that reflect the assets management to achieve its business objective, business model assessment will be applied to that level, and it is not by instrument but higher level of aggregation, and the aggregation does not mean that it has to be applied at entity level. Single entity may have more than one business model. For example, there may be a portfolio of financial assets that is managed to collect the contractual cash flow, while other portfolio may be there to realize the fair value changes. So objective of first is to collect the contractual cash flow by holding the assets till maturity, and this portfolio of assets may have objective to realize the fair value gain. We may need to split the portfolio of financial assets into subcategory for better reflection of management of the portfolios. But this split of portfolio is possible only if the financial assets are determined and separately identifiable.